Welcome to the Real Estate Investing Morning Show with your hosts, Wayne and Gabby.
Hey, good morning.
Good morning, real estate investors, and welcome to the Canadian Real Estate Investing Morning Show. On today's show, we got a very exciting show for you guys today. We're going to do something that we don't normally do. We're going to do something that everybody's always asking us to do, but we never do it because I hate doing math first thing in the morning. But
Mess it up.
I always mess it up. I always screw it up, but I came with notes. Here's the thing. We're going to do something that everybody always wants, that everybody wants to see. And that is we're going to do a real life case study. We're going to do a real life deal analysis. And this is an actual real deal. And the reason why I know it's real is because it's ours. It's ours. It's one of our real deals. And I don't like to pull back the curtain on our own personal investments very often because I don't like people criticizing my investments. Plus, it's personal. It's like, do I go in and look at your RRSP statements every year? No, it's none of your business. But I think that people want to know that this actually works. I think that people want to know that what we're teaching and what we do, what we do actually works. And we're going to show you that it actually works. We're going to show you a real deal. And it's going to shock you how incredibly basic this deal is and how incredibly amazing the returns are. We're going to go through all the details, everything you need to know. And I hope that it inspires you. I hope that it gives you the confidence to be able to look at this a little bit differently. And I also hope that the simplicity of it also inspires you and encourages you, because there's too much going on in this industry of all these fancy gimmicks of people trying to do all these maneuvers and things to optimize and to try and leverage and to try and get the best possible returns. And trust me, I love that shit. But what it ends up doing is it kind of dials up the risk meter a little bit. And what ends up happening is newer investors who don't have the experience, who don't have the systems, who don't have the know-how, they tend to start making mistakes, beginner mistakes. And those really cool gimmicks and schemes that people have been teaching, they don't really work because, well, it was already high risk to start, and then you had a newbie investor try and do it, and they messed it up. So we got to stop doing this. We got to simplify things because there is a way.
Yes.
There is a way to get amazing returns with incredibly low risk with very, very simple, tried and true strategies, and we're going to share that with you guys today.
You know what I love most about this, Wayne?
What do you love most about it?
Well, you guys know I'm not a numbers gal. Wayne hands me a property and says, manage the shit out of this. And I say, okay. And that's woohoo, yeah. And that's as far as I like to go. So when you just like went over just like this is, the property that I'm going to talk about, basics, yada, yada. I don't know what the numbers are. I don't know. I know that that we do well and that, these properties perform well. But it's kind of like I also get the inside look into it that I never ask for. Of course, I could have it at any time. I could be like, Wayne, what's going on with this property? But I don't, because I don't really like numbers. So it's like, it's kind of fun for me too.
Well, the thing is that when you're doing basic long-term buy and hold, and I hate even saying basic because people are like, I don't want to do the basic. I want to do the fancy. I want to do the big one. I want to scale. Trust me, guys, you don't need to scale. At least the definition of your definition of scale. You don't have to buy bigger. You can buy small and get amazing returns, right? And this is what I try and teach people is that people are trying to overdo it, trying to overcomplicate things, trying to take on higher risk strategies and higher risk asset classes, all just because they feel like this is how you get bigger. You don't need to. And I'm going to show you guys today the numbers. But honestly, I lost my train of thought. God dang it. I had a really good point. Honestly, this is just really simple stuff. And we're going to show you guys can you just remind me what you said? I'll remember what I was going with it.
I don't like the numbers. I get a sneak peek. It's fun for me to be able to see how they're performing.
Oh gosh, it's so early in the show and I already lost my train of thought. The reason why I'm losing my train of thought is because I brought a shit ton of notes today. And there's so many different numbers that we're going to be going through. Yeah. And that's why I'm trying to remember all these different things that I want to share with you guys. But you don't have to overcomplicate these strategies. What you could do is just buy simple, basic properties and get amazing returns. If you do it right. It's really important not to misstep. It's really important just to, it was something to do with long-term buy and hold. I'm trying to keep talking and then maybe
Well, you also need to make sure that you manage the shit out of them or have somebody managing the shit out of them like me. Where's your Gabby?
Absolutely.
Because you can mess up the numbers by not managing the shit out of them.
I remember what it was.
Okay.
Long-term buy and hold is slow. That's what I was trying to go with. So just forget the last 30 seconds, and I'm going to get back to what I was saying. The reason why Gabby doesn't see it, and the reason why Gabby's like, well, how much are we actually making, is because with long-term buy and hold, you don't really make any money. Not that you don't make any money, but a lot of the money isn't made until the long term, right? And there's typically a hump that you're going to get over eventually at some point where you're going to start to notice that the cash flow starts to increase significantly more. And you're also going to see that the mortgage pay down starts to go down significantly faster as well. And that's the reason for that, is that with 30-year amortization mortgages or longer term amortizations, a lot of it is that you pay a lot more interest. Like every month you pay a mortgage payment. Of that mortgage payment, a lot more goes towards interest in the beginning and less goes towards mortgage pay down. But as the balance of your loan goes down, as the balance of your mortgage goes down, what ends up happening is your mortgage payments essentially stay the same. And as the mortgage payments are higher, but the balance is lower, that means more is going towards paying down the principal, the balance of the loan towards the end, and less is going towards interest. So it kind of does like this declining scale thing.
Yeah.
And so that's why in the beginning, like you're looking at the mortgage pay down for the first 3 or 5 years and like, this is bullshit. Wayne told me just to focus on the mortgage pay down and I only made $3,000 this year off of it. Yeah, in the first few years, but you'll notice towards the 20th year, you'll notice it's significantly more because the payment's the same, but it's far less on the balance. And I think it's important to understand debt and equity and how mortgages work to understand the mathematics of it. But it is very difficult for people in the first few years to look at long-term buy and hold and think like, how is this scalable? How is this going to be profitable?
Yeah.
You just have to understand how the math works.
Yeah.
And if you understand it, you'll see the potential for it. And the property that we're going to be sharing today is right at the 8-year mark. And the 8-year mark, mathematically, in my opinion, is the hump. 7 to 8 years, I call it 8. The 8th year is the hump. The 8th year is typically when you start to see the cash flow start to go up significantly. The 8th year is also when you start to see more of the mortgage being paid down every year and less going towards interest. And it continues to keep growing over time. Permitted that you're not refinancing properties and pulling out equity and leveraging and things like that, using all those creative strategies that we teach in order to leverage and maximize your returns. If you just keep it there, what you're going to notice is mathematically around that 8-year mark, this is when you typically start seeing things growing and becoming more noticeable. And I use this property as an example because it's right at the 8-year hump. And what you're going to notice is that the returns are absolutely phenomenal. But had you looked at this property at the 3-year mark, you would have said that is fucking pathetic. Right. So it's interesting, right?
Yeah, it is. And if I can touch on that, because you'll see so many new investors like in their first like year or two of investing, year 2, 3, even 4. And they're looking at these, you know, come tax time, right? And you're filing your taxes and you're like, okay, how much money have I made this year from my properties? And like in the first year is the funniest because depending when you bought the property, say you bought it like well into the year, and you like most of the time it'll be like, oh my God, like I didn't make anything. It's a negative because you had like upfront costs and maybe a month of vacancy while you took possession and needed to fix it up before you could get somebody in and all these things. There's all this stuff that happens. Then you barely put a dent in the actual mortgage, right? Like you just nick it. Right. And so they're looking at this and they're like, I didn't make anything. It's actually like I'm negative on it. Like, what the heck? And then like the second year comes and the third year comes and it's such like a minuscule amount that people can't wrap their head around it. And if you don't have that long-term vision of long-term buy and hold, it's easy for people to be like, this is bullshit. This isn't making me money. I can make more on my RRSPs. I can buy gold. I can invest in stocks. I can do all these other things that are going to make me way better returns than this. Mm-hmm. And then they're like, this sucks. This is bullshit. I'm going bigger. Yeah. Right. So like they'll sell
at the 3-year mark because they're like, this isn't working.
Maybe they sell, maybe they hold them, but they decide this isn't worth their time. This is bullshit. I'm going to do something bigger and better. And you'll see these people who you'll go into the community and you'll see these people who are out there going like, bigger's better, multifamily, this and that. And you look at their history, how long they've been in the game, and it's like, and they're also the people who are shitting on on long-term buy and hold
and residential.
And they've only been here for like 3 years, 2 years, 3 years, 4 years. They haven't seen what long-term buy and hold can do because they didn't have the long-term vision of it, and they weren't patient, and they just didn't understand the process, right?
Yeah. Well, you just explained it right there. They didn't have the vision. They didn't understand the process. Yeah. And that's what it comes down to, is not having proper education.
To understand that in the long term is when the mortgage starts to get paid down and the cash flow starts to increase.
Put yourself in our shoes, in an online culture, or even in a networking room, but more so in the online culture, because there's far less people talking in person, and there's a lot more of this and this. Just in the online culture, when someone shares an opinion, or better yet, we share a story like this online. If I were to put this online today, what I'm about to explain to you guys.
Let's do it and let's watch.
I don't want to. And I'll explain why. If I were to instead share all the details of this through text online today, I would get ripped to shreds in the comment section from people telling me that this is better, or this thing over here is better. Now imagine me trying to explain why my opinion, when somebody else is sharing their opinion, but they don't understand how to actually mathematically put it together. So it's just going to be, I'm right. No, I'm right. No, I'm right. And then there's me on the other side. Well, here's all the mathematical blah, 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 blah. And they're like, that's not right. This is bigger. This is better. Economies of scale. And you understand what I'm trying to say? It's impossible to debate with people online who are ignorant. And I'm not saying ignorant is a very negative, like people call people ignorant, like they call them. Ignorant is almost like calling someone fuckface. People just use it as a very, as a mean term. But by definition, someone who refuses to listen and refuses to hear the other person's side and refuses to actually learn how to do it properly is ignorant. So I'm dealing with ignorant people online. It's impossible to debate online. That's why I don't. That's why I don't put any of my opinions online. What's the point? What's the point if nobody's listening because they don't understand what we understand? So the point is, for you guys, is that education and understanding the fundamentals and the mathematics of real estate investing is so incredibly important. Not for your ability to debate, but for your ability to get the strongest possible returns with the lowest risk. You have to learn it. You have to, because if you just follow other people's buzzwords and you follow other people's opinions blindly without actually understanding the math underneath it, what's underneath the hood, you're just following blindfolded. And you're hoping. And what ends up happening is that eventually you come to the realization at some point, and by then it's too late. You've wasted 10 years, right? The whole point that we get into real estate investing is to get amazing returns on our savings and for our investors with the least amount of risk. Mm-hmm. And we're going to show it to you guys today. And I hope that it really helps you. I hope that it opens the door for more opportunities and possibilities for you guys, but I also hope that it provides you more clarity, again, to understand how to do this. It's a very difficult thing to do on a podcast. I wish I had a whiteboard. I'm going to try my best. And if you're listening to the audio on Spotify or Apple Podcasts, it's going to be even worse. But just understand the reason why I'm doing it here is because I don't want to do it online, because I don't want to argue with ignorant people online. I'm going to do it here in a safe space. And they can fill the YouTube comments as much as they want. I'm not going to respond. Okay? We're going to take a quick little commercial break. When we come back, we're going to dive into it. And we're going to show you guys exactly how to go about doing this and exactly why long-term buy and hold works. We're going to use real numbers from a real deal of ours. You're going to absolutely love it. We'll be right back.
Real estate investors need to treat debt differently than homeowners, and at Kirkland & Brennan Mortgage Group, we understand that. For the last 11 years, we've helped real estate investors plan and build their portfolios. We understand how to help you avoid fees, penalties, getting yourself stuck, and making sure that the deal you're doing today doesn't stop the deal you want to do tomorrow. You can reach out to Keaton, Keaton, at kbmortgages.ca. Put plan on the subject line, and we'll help you build a plan and then realize it for your real estate goals. We also coordinate with the other professionals like your accountant, lawyer, realtor, and we will help you build your portfolio. So reach out. We'll do our best to help. Thanks, guys.
You've got showings, lease signings, suite renos, condo board meetings, credit checks, mortgage financing, and every so often the tenant clogs the sink because they shoved macaroni down there. Stop. Breathe. Leave the bookkeeping to Fingo. Fingo is specialized real estate bookkeeping by real estate investors with tailored services for maximum returns. Save time. Enhance your returns. Claim the plumbing repair for that ridiculous macaroni fiasco. Book your free consultation at fingo.com.
Summer. While everyone's getting distracted, this is when the market gets quiet. Not because the opportunities disappear, but because the people do. Vacations, long weekends. These are the distractions I'm talking about. And that's exactly when serious investors make their moves. At Calvin Realty, this is one of our favorite windows. Less competition, more flexibility, and sellers who are actually open to negotiating. While everyone else is stepping away, we're stepping in. If you're looking to buy right, not just buy fast, this is your edge. Calvin Realty. Opportunity doesn't take time off.
And we're back. So apparently Kirsten loves the numbers.
Great.
Yeah, Kirsten says the numbers are the best part. You know what? I'm really happy for you number nerds. I am.
Good.
There's a part of me that wishes I had that, but there's also another part of me that just accepts who I am. And I can let that part go and I can just do what I'm good at, right? So I have somebody who is good at them. I trust them. That's fantastic for me, right? I'm happy for me. And we have lots of people here joining us live. So good morning to all of you. And Tristan, I hope your coffee is hot. Cheers.
Yeah, right on. So yesterday, Gabby and I went to the lawyers.
Yes.
And this is kind of what inspired today's episode because I wanted to share the details of that deal that we went to the lawyers for. But that deal was a little bit complicated. So the deal that the reason why we went to the lawyers yesterday was because we were signing papers for the final closing of a rental property that we are selling.
Yes.
And that deal was approximately, I think we've owned it we've been a part of it for about 7 years, approximately. And that deal there was a very creative deal. It was lots of different creative financing on it. But that deal there, and it was really cool. We went out and we did a little celebration thing last night. We remember we told you guys yesterday.
Listen to our own advice.
The 18th, box on the checklist.
Celebrate.
Yesterday we went and celebrated. We went and we watched. We couldn't watch the Canada game because we were busy, but we ended up watching Scotland versus Brazil afterwards. And we went out and we had dinner and we turned our phones off and we said, we're going to enjoy this. We're going to celebrate this deal here. Because we don't sell properties very often. It's not that we refuse to sell rental properties. It's that there is a time and a place and a strategy behind selling rental properties, which I'm not going to be getting into today. But we're very strategic about the sale of properties to get the highest possible value to make sure that it makes sense for our portfolio and the goals that we have. And so it was worth sitting down and really just taking a moment to be proud of ourselves for this deal, because this deal was from start to finish. It was difficult. It was creative. But I'm so proud of the creativity that we put together in this deal to be able to get it to where it was, because this deal made just a little under, this property made just a little under $300,000.
What?
Yeah. Just a little under $300,000.
That's a lot of money.
It is a lot of money.
Okay.
It is a lot of money for 7 years, right?
Yeah.
And it's just a normal, basic, single-family house.
Yeah.
Right? How is that even possible? And it cash flowed. And it was great. It was complicated.
Yes.
But nothing that we can't handle, right? Yes. But I'm so incredibly proud of us for being able to do that. Now, is this a life-changing deal that we're going to retire from? No. But it's just one piece of the puzzle, right? And if you own many, many properties like this, it's not about quitting your job. It's not about replacing your income. It's about getting the best possible returns in your investment and building towards a future goal of whether that be financial freedom or whether that be a sufficient retirement or what you're going to leave behind for your kids afterwards, right? This is what we focus on. Our real estate investments are for the future. They are investments. They are not job replacements. I don't know how many times I got to say this. I'm going to keep repeating it often so people hear it, just in case you missed previous episodes. We do not live off of our rental income. We do not live off of our cash flow. We live off of our business income. We do not live off of the cash flow from our real estate investments because they are investments. Investments are long-term.
Yeah.
And this investment here made $300,000 in 7 years. Okay? It's a very, very, very good deal. Yeah. Yeah, and what Gabby doesn't know is
Carmen says pardon.
Yeah.
Oops.
What Gabby doesn't know is that all of our deals are like this, but we don't see these because we don't sell them, right? A lot of these, what ends up happening is in the first few years, you'll look at the mortgage balance every year and you'll be like, it didn't make all that much money. And then you'll look at how much it's worth compared to what we bought it for. And you'll be like, oh, okay, it's gone up in value, right? And you'll see $300 or $500 or $600 a month in cash flow. You're like, okay, that's cool. But you're not multiplying it by 12 and then multiplying it by the amount of years. You don't realize that $500 a month is $6,000 a year, which is, $35,000 over 7 years. You don't see all those numbers start to add up over time.
Well,
right?
that's what that like from my perspective, like I'm the one who, does taxes and a lot of the bookkeeping, like a lot of the just management of it all. And so like on a yearly basis, but like I do that with like every single property. So I'm not paying attention to, any particular, over the long term, this every single year equals this. Like I'm not looking at any of that. I'm also not looking at what the current values of these properties are either on, what kind of growth there's been. So I'm very just like focused in the now. Yeah. Right. So to put that all together is actually kind of mind blowing.
Yeah, it's amazing.
I don't know, like if you could see I'm kind of spaced out because I'm like, I'm trying to put pieces together. I'm like, how does that actually, like what? Wait, what?
Well, the thing is that a lot of people are asking about the details of this deal, and I already explained that this deal is way too complicated, and it utilized so many different forms of creative financing, which got us to this point. Yeah. And I can't explain all the ins and outs of it. There's not enough time. Plus, it's a little personal. These are our personal investments, so I have to be cautious of how I speak about our personal investments and our personal finances. So I'm not going to share the details of this deal. I just wanted to share that this is what inspired it. Yesterday, we went and signed the papers, and I believe that property is selling in like a week or so.
July 2nd.
On Gabby's birthday.
The fun part of this one is that the proceeds hit our bank account on my birthday.
That does not mean you can spend it.
We're going on a shopping spree in Kelowna. Actually, no, they have way too much taxes. I'll wait until I get home.
Yeah, we don't need none of that HST. Do they have, what do they have? They have GST, PST. They have harmonized tax, right?
They have, I don't know. They got all the taxes.
All right.
They got taxed up their butts. Go ahead.
Okay. Anyways, so we're not going to talk about that deal, but I do want to talk about numbers and how they work. And this also stems from a coaching call that I had recently, and I was struggling to explain something to an investor because they didn't quite understand how the math worked. And they were trying to compare one strategy to another strategy. And I was explaining, well, it's 6.5 dozen. It's the same. And they're like, I don't understand. Because, and then they kept quoting things that I've heard other people say online. They kept quoting things that you typically hear plebs on podcasts and YouTube say. You know what I mean? They kept quoting Instagram plebs. Being like, you got to do it this way. You got to buy this. Never sell a property. All these one-liners and buzzwords and things like that. And whenever I hear things like that, I'm like, okay, or but, have you taken this into consideration? Those types of things. So I don't like it. So I kept hearing those things in their voice and in the way they were saying it, but they weren't actually focusing on the numbers that were literally right there on the screen. I'm like, just look at this. You see it? And just they couldn't quite comprehend it or grasp it. So I realized that it reminded me that not everybody sees the numbers, the digits, like I do. And that's okay. That's perfectly fine. And not everybody completely understands how the profits work, what equity is, what debt is in real estate investing. A lot of people just see it for, I'm going to buy it. I hope it goes up in value. and that'll be my profit. And a very one-dimensional view where I'm looking at it, through the matrix. I'm looking at it in four dimensions, and I can see everything and how it all plays in, and I can understand the risks of everything and the gains, and also, where the levers are that you can pull in order to maximize it and how much risk you take on when you pull that lever, right? So what I want to do is I want to pull back the curtain on a very simple deal today, a very simple and profitable deal today. That is one of our oldest properties. It's one of our most basic properties. It's a property that Gabby and I never, ever talk about. Mm-hmm. And the reason why we never talk about it is because it's so incredibly automatic.
Yeah, it's been a very boring property, which is fantastic. That's my favorite kind of property, is a boring property, because it requires the least amount of management.
Yeah.
It takes the least amount of time out of my year every year to manage. Well, there's a yearly renewal that goes out, a one-page addendum that gets signed, and that's it.
You like it from the management side,
yes,
of course, but I agree. I think the less time you have to spend on that investment, I think the higher the return. Like a lot of people, they look at the numbers for the return, but I also look at my return on time.
Yes.
And I have some properties that have higher returns than this, but they require 10 times as much dedication and bandwidth. I got some properties that, like, literally, we're always talking about them.
Yeah. They come up over and over and over again. Yeah.
And maybe I might not be there turning a wrench, or maybe I might not be there every day hammering a nail, but it's fucking hammering nails into my head every goddamn day because I have to constantly think about how to stay afloat. Yeah. Not necessarily how to stay afloat, but more like, okay, we got another problem here. We need to find a solution. Or, hey, what are we going to do about this? Or, hey, this person said this. What should we do? And it's like constantly having to be top of mind, which I don't want that to be top of mind.
Yeah.
This is not my active business. These are my long-term real estate investments. I want to put this into my portfolio. I want to set it, and I want to fucking forget it. I don't want to think about that. Because if I have to think about every goddamn single property, I'm going to have an aneurysm. Seriously. Yeah. That's not why I get into this. This is for my long-term investments. These are for us to put our money or our investors' money into, for us to set up the systems that we've built and refined and mastered over the last 15 years. Mm-hmm. So we can just set it and forget it, and it's automated. That's what I want. Yeah. But so many people are buying these properties that require so much hands-on, what's the word I'm looking for?
Like management.
Yeah. And also so much thought and consideration.
Yeah. Mental management.
I want you to consider this. How is that scalable? How is that freedom?
Yeah.
It's not, I promise you.
Yeah.
Because half my portfolio is on the verge of giving me a fucking aneurysm. Yeah. And then I look at it, and by the way, Gabby looks at it. I have perspective. I can see the big picture. I know how much money it's going to make in 5, 10, 15, 20 years. I can see it. I have perspective. Poor Gabby over here is looking at the...
I'm so single-minded.
Gabby's looking at it from
simple gal.
Like playing checkers. She's looking at this, and she's looking at the numbers at the end of the year, and she's like, why the fuck are we doing this? Why the fuck am I putting up with this shit? My job? How is this profitable? Why don't we sell all of it
and go get jobs?
Instead, because she can't see the other side of it. And in the beginning,
seriously, these are thoughts that hit me every once in a while. I'm like, can't we just go get jobs?
Why are you buying more of these? I'm like, Gabby, just expect.
I know.
Just calm down. It's coming. Just be patient. Just wait for that 8-year hump. I promise you.
And guys, I'm not crying. I have a leaking eye all morning since I woke up. So
she's just
I'm okay.
proud of our returns. She's just proud of our returns. So the reason why we buy simple, basic properties is because we want it to take up the least amount of bandwidth possible so that it's scalable. So that we can buy these boring, basic residential properties at scale so that we can get phenomenal returns that we're gonna realize in 8, 10, 15 years. Okay. And so this property here, I'm gonna go over the details of it. This property here was purchased in 2018. Okay, so 8 years ago.
It was a good year.
It was a good year. And we purchased this property. It was a single family property with a garage. Okay, it's got a yard. It's got an unfinished basement. It's got 3 bedrooms. It's got a kitchen. It's got 3 bathrooms. 2.5?
Yeah, 2.5.
2.5. 2.5 bathrooms. It's got a dining room. Got a living room. 2 stories.
It's got some stairs.
Yep. Stairs upstairs to the bedrooms. Yep, absolutely.
Even has a washer and dryer.
Washer and dryer, furnace, hot water tank. Anything else to add? Oh, I think it's got a fireplace.
Yes.
Electric fireplace or gas?
One of those.
Wish it
Not
didn't.
wood.
Wish it didn't. Wish it didn't. That's just one more thing that we gotta maintain. But,
We did need to service it a couple times.
Anything else?
I think that's about it.
Pretty boring.
Yeah.
Sounds like every other house.
Mm-hmm.
Okay. How many doors does it have?
Several.
But not like multifamily doors.
Oh.
Just like a front door and a back door?
Just a front door and a back door.
Front door and a back door?
Yeah.
Classic. Classic house.
Decent size yard.
Classic. Decent sized yard. Enough
Yeah.
for...
Not huge, not small.
Can you do a cartwheel?
Oh, yeah. So many cartwheels.
2 cartwheels?
Yeah.
How many cartwheels before you hit the fence?
Let's say 20.
20 cartwheels. Do we measure yards and cartwheels now? Almost like they measure cars, like speed and horsepower? We're
Horses
gonna measure...
by hands?
What's that?
They measure horses by hands?
Yeah. I think that we should start measuring yards by cartwheels.
Okay.
But a pretty basic, boring,
Yeah.
normal house
Yeah.
couldn't possibly be scalable. Couldn't possibly get great returns. That's a home. That's not an investment property. But, why did we buy that property in the first place? We bought it because it's something that people actually want to rent.
Yes. Yeah.
Do families want to rent 1-bedroom apartments?
Nope.
No. Do we want a 50-year-old individual who is on provincial insurance, who is right at the cusp of affordability? Do we want, or would we rather have someone who is a dual income family, 2 great jobs, 2 kids, they go to school in the area, and they're saving up for a down payment, but they can't quite, so they're going to probably stay there until their kids at least graduate, because they don't want to be uprooted and they want and away from their friends.
That sounds great.
Long-term tenants.
That sounds great.
Affordability is there. They make more than enough, and they love the area, and they're going to treat it like their
Home.
not like a rental.
Yes.
Yeah, that sounds pretty dope, actually.
Yeah.
That's exactly what I want as a tenant. That's exactly what I'm looking for in a tenant. So therefore, I'm going to buy the property that my tenant wants. I'm going to buy the property that my tenant will refuse to move from. Right? So that's exactly why we bought it. And we bought it in a great area next to a school where people are going to want to stay there. And we bought that property in 2018 for $250,000. Now, we're using very rough numbers today because I have a lot of numbers I need to go through. So I'm using even numbers today. We bought that property in 2018 for $250,000. Now, that property was pretty stale for a while because the Alberta real estate market was pretty flat for quite some time. Like 12 years-ish, something like that. We didn't see properties, and it was a relatively new property. I think it was like 10 or 15 years old or something like that. It was a relatively new property. And but Alberta was pretty flat as far as prices go for quite some time. And rents actually were kind of flat, and they were going down a little bit, in fact, because 2008 happened. And then rents started, balancing a little bit there. And then 2016 happened, and we had not extremely high, but we had high vacancy rates in 2016 to 2018, which led to rents softening, and very similar to the rental market that we're in right now, actually. Very much there was less people looking and more supply. And therefore, it was a little bit harder. There was a lot more incentives going on at that time to try and find tenants. And a lot of people were kind of pulling out of that area, pulling out of Alberta, because they were like, this is boring, this is flat. Ontario's fucking killing it. Let's put our money there. And we saw opportunity in it because we knew it was coming, right? We knew that eventually that the values were going to be going up, but it was just a circumstance. And we took advantage when everybody else was looking the other way. We got in and we started buying good, reliable properties that worked. We bought properties that had great returns, regardless of appreciation, that were very strong in cash flow, that met the 5% rule, even when the rents were down, even when the vacancy rates were up, because we knew that long-term, holding this property for 15 to 20 years, this was going to absolutely kill it, right? And that's the important thing. And I want to highlight that because we are in that right now again. And I'm talking a lot about how people are saying it's time to sell, time to get out. It's not that good. I'm just saying this property here is a great example of what that looks like and what the market looked like at the exact same time. And I want to show you guys just over the long term how this all plays out, because that property did absolutely nothing with the value for about 4 or 5 years. Nothing. It was boring. And I'm watching all of our other colleagues across the country. Values are going up like crazy, and they're buying up properties and they're refinancing properties, and their values are going up and they're getting solid returns because of appreciation, but they're just chasing appreciation. And none of those properties, were sustainable because none of them had the strong cash flow that we had. None of them passed the 5% rule. And then sure enough, once the music stopped and everybody was looking for a chair, all those people landed on their ass, right? And here we are with our nice little boring property, this nice little family that absolutely loves it, doesn't want to move, right? And then sure enough, exactly as expected, the values start to go up. We finally found that perfect pocket. Now, there was a bunch of other things that happened in between that time, which led to everything and how it all played out. But that property eventually did realize its gains. And today, that property is now worth, we bought it for $250,000 8 years ago. Now it's worth $380,000.
Is that 130?
That's $130,000 worth of appreciation.
Wow.
on that
In 8
$50,000 investment.
Wow.
Right? And $130,000 of appreciation, 250,000 is what we paid for it. That's about a 50% increase in value.
That's what I was just thinking, yeah.
Right? That's about a 50% increase in value. Actually, the average yearly appreciation rate. So if you want to know how, like if you were to look at that, like what would be the annualized appreciation rate? It's just a little over 5% per year.
Okay.
Which some might consider boring.
Yeah. Not exciting.
Not exciting. They say you can expect historically over 100 years, like real estate goes up like 3% per year. So 5% per year is like nothing all that crazy. But got to keep in mind for that first 3 or 4 years, there was nothing. And then pow.
It all hit. Yeah.
It hit really fast. So everybody looks like a genius when they're buying right when it happens. But we saw it as, hey, we're going to be in a slump here for a little while, but it's going to catch up eventually, and then it's going to annualize to 5% per year, right? But, other people will be like, oh, my property went up 15% just this year. Okay, but it was
How long
stale.
have you had it for?
It does not go in a line like this, guys. It goes in a line like this, right?
Yeah.
And so you have to understand that. And so you buy when other people are scared, and you can get the best possible deal, right? Because if you try and buy now, well, here's the thing. You can try and buy now, and values, do continue to keep going up, but do the numbers still work? based on today's purchase price, based on today's rents, based on the financing of it all, would it still perform the same way that it does or it did before? No, because the value is higher.
Yeah.
So you have to buy it early when the numbers work, regardless of appreciation, and set it up as a business that is profitable. Again, that has good cash flow, that has good profits and mortgage payment and everything else, and that it's profitable regardless of appreciation. It's very, very, very important. So that's why it's important to buy at the right times and not buy when everybody else is saying to buy, not buy when it's hot. Okay? It's an important distinction there. But $130,000 in appreciation in 8 years. I mean, that's phenomenal.
Yeah.
I think that's absolutely phenomenal.
Yeah.
Right?
Absolutely.
Again, on a $50,000 investment, because we bought that $250,000 house and we only put 20% down. Right? Cash flow. You guys are curious about how much cash flow over that 8 years. Now, we were very fortunate with the mortgage terms and everything else that worked out. We made $62,000 approximately in cash flow over 8 years. $62,000. You writing this down?
Yeah.
Okay.
Just trying to stay in it.
Now, that's the full cash flow. And so when you're doing your performas, people will typically look at a performa very one-dimensionally. They'll look at the performa being like, okay, what's my rent? What's my expenses? What's my take-home every month? Because this is what I'm going to live off of, which is the wrong way to look at it. Additionally, when people are running performas or you're getting your realtor to run your performa for you, which is a terrible fucking idea, by the way, because those numbers are not accurate and they're hyper-inflated and padded because they want to make the deal look good. I digress. When you're looking at a deal, typically people put, well, I'm going to put 4% for repairs and maintenance. I'm going to put 8% for vacancy. I'm going to put 5% for property management. I'm going to put this. I'm going to put CapEx. I'm going to put this. I'm going to put 3% increases for rent. I'm going to put 4% increases for appreciation. They're going to put all these numbers in, which are all hypotheticals. And I think that it's important to run the proforma to see how it performs, but the most important reason why you run a proforma is see how sustainable is this property. Because if there is 4% for repairs and maintenance, if there is one vacancy every year, so you put 8% for vacancy, if there is all these other different things, you want to know, is it still going to have enough cash flow in order to stay afloat for this property? That's the whole purpose of our proforma, to see how it performs as a business.
Worst case scenario, kind of.
Worst case scenario. Not to see how much money you're going to live off of. Right?
Yeah.
Stop treating real estate investing as a fucking source of income. Please, for the love of God. If you want to treat it as a source of income, you can. Just wait 15 years. And I'll teach you how to do that if you join our mentorship program. I'll teach you how to set it up for success and reverse engineer your goals. But not on day one. Anybody who says that's a fucking moron. Okay? They're just selling you a fucking dream.
Yeah.
Don't listen to them. Watch too many people fucking go bust.
Yeah.
Because of that.
Yeah,
Stupid.
We've watched it.
Stupid. But it's $62,000 worth of cash flow total. Okay? Now, we did run a proforma. We did run it and we said, okay, what's our rent? What's our property taxes? What's our insurance? Right? Should we be setting aside money for repairs and maintenance and vacancy and things like that? We teach our students and we ourselves do not spend any of our cash flow. All cash flow goes into the reserve. So that way, if we ever do need any money, we never have to worry about it. I watched a guy on a YouTube video or a fucking Instagram video or something like that yesterday, and he's talking about how he didn't have enough cash flow, or he had cash flow, but then he had 1 month of vacancy and all of his cash flow went away. And I was like, what does that even mean? Dude, like, why are you spending your cash flow? Why are you spending money out of your pocket for a vacancy? He was saying something like, after 2 months worth of vacancy, most people would have to sell their property.
Oh my
Like,
gosh.
what does that even fucking mean?
Oh my gosh.
Dude, put your cash flow in a reserve. Let it build up to $20,000. Then you never have to worry about it.
What idiots.
It's the same people that say, oh, we need multiple doors in a property. Because if you have more doors in a property, if you have a multifamily property, if one unit's empty, then the other ones can support it. Like, why would that even, that's such a fucking back-asswards way of looking at it. Put all the cash flow in the reserve, and then you don't have to worry about how many doors you need in order to support the property. People buy more doors to solve a problem that doesn't need to be solved. Their whole logic is that if I have more doors, then therefore I'll never have to worry about paying. So I can spend all of my money in the moment. It's like counting your chickens before they hatch. It's exactly what they're doing. They're spending all their cash flow and then like, oh, fuck, I got 2 months worth of vacancy. I better sell this property. Instead of just taking the cash flow, not spending it, putting it in a reserve fund, and then you'd be fine. I digress. We had $62,000 in cash flow. Where did all that cash flow go?
Nowhere.
In the fucking reserve. In the reserve. It went into the bank account. It sat there. That's what it's been doing for 8 years. Oh, that's not the best use of your funds, Wayne. Yeah, of course. Like over time, we did pay some of that cash flow out.
Yeah.
Right? But we don't plan to spend it. Cash flow every month goes into the reserve fund. Okay? If after a while there's $30,000 in there, do I really need $30,000 in there? Even if I have 3 months worth of vacancy, I got to pay for a furnace, a roof, and a hot water tank. I still got lots of money left over. So every year we assess it with our joint venture partners. Hey, do we want to pay out $5,000 each? Okay, cool. But we always make sure that we have a sufficient amount. And by sufficient, I mean a heavily sufficient amount of cash flow in that bank account so that I never have to pull any money out of my own pocket. And I never have to ring up my joint venture partners and say, hey, man, so the hot water tank went, so I'm going to need some money. Or, hey, man, so vacancy rates are up and this property's been sitting for 2 months. I can't find a good tenant. I'm going to need you to send some money over. No, we don't do that. Right? So therefore, because we set it up that way, we don't need more doors to solve that problem. One less reason to do multifamily. I digress. Just making points while we're along here. So $62,000 worth of cash flow on this property, okay? We talked about the pro forma and setting aside money for reserve, setting aside money for repairs and maintenance, setting aside money for vacancies. But those are all projected. Those are all safe numbers.
Yes.
What's the actual numbers? And this is where people really need to understand is there are projected numbers and there are actual numbers. And most people never get to see the actual numbers because they never set themselves up for success to actually last in order to see the profits. We're going to give you actual numbers so you can see just how profitable it actually was. Of the $62,000 worth of cash flow, we had $12,000 in expenses over the 8 years. And this is just normal repairs and maintenance stuff. And I think one vacancy, but I don't even think it sat empty. No, it didn't. I looked it up.
No.
We didn't have any vacancy because one person moved out
Yeah, we've had 2
and
tenants.
another person moved in, but they didn't sit empty. Didn't sit empty. Because it was such a great property that people wanted, we didn't have a month of vacancy. One person moved out, the next person moved in later that day. No vacancy. So no vacancy cost, just $12,000 worth of expenses and like repairs and dishwashers and that type of stuff. Just normal stuff that you're going to have to deal with. So $62,000 worth of cash flow, $12,000 worth of repairs and maintenance expenses. Means that it was a total of $50,000 in cash flow. Again, there's that huge bank account of just $50,000. Now we've paid some of it out to our joint venture partner on that property. Okay. But there's got to be at least $25,000 in there right now. At least. Doesn't necessarily matter.
Yeah.
Okay. So $130,000 worth of appreciation, $62,000 worth of cash flow, $12,000 worth of expenses. Here is the boring part, and it's actually quite funny. I think I saw someone say this in the chat here, and I'm seeing lots of comments here. I'm quite impressed with Victoria. Because she absolutely nailed the mortgage paydown.
Okay.
Because the mortgage paydown is probably the least exciting part of this whole case study. Because, as I said earlier, mortgage paydown in the first 8 years is incredibly discouraging.
Yeah. Very interest heavy.
Very interest heavy. Even with the good solid interest rates that we had during this time. Because we dodged bad interest rates on this property. So we had mediocre, I'd say an average of like 3.5% interest like if you took an average over
Right.
the 8 years.
Right.
Very mediocre. And on a property this size as well, you got to keep in mind that it's a relatively small mortgage, right? We're just hitting the 8-year hump right now, and this is where we're starting to see a lot more going towards paying down the mortgage every month or every year, and a lot less going towards interest. But the mortgage pay down, so how much we've paid down on the balance of the loan for that property over the last 8 years, was $40,000. $40,000. I can't believe. Nailed it. It was absolutely very impressed. Very impressed with that. So let's start to add it up here. We've got $40,000 in mortgage paydown. You guys following along? I don't have a whiteboard, so you're going to have to follow along yourself. We've got $50,000 in cash flow. Okay? And we got
62 minus expenses. Okay, 50. Yeah.
And don't go ahead too far. I got things to say. And we've got $130,000 worth of appreciation. All right?
Mm-hmm.
Before I go any further and start totaling things up and talking about return on investment and things, and return on investment and other things like that, what I want to share with you guys is that what I'm doing right now, adding up the mortgage paydown, adding up the cash flow after expenses, actual expenses, and adding up the appreciation is the simple and easy way to determine how much profit you've made on a property. I don't care how fucking cool someone's calculator looks and all the built-in formulas and all that other shit. This is how you actually run the profits. It's really super fucking simple, and I'm doing it on my iPhone calculator and my notepad. You do not need to overcomplicate this. And you can do this exact same thing, comparing it from an apartment condo to a single family house to a suited house to a 25-unit multifamily building. This is how you compare property to property, apple to apple, okay? It is really that simple. How much mortgage have I paid down? How much cash flow do I have after I've paid off my repairs, maintenance, bookkeeping, and all that other shit?
All the expenses.
All the expenses. And how much is the property worth less what I bought it for? How much is it appreciated? And then you total that up. Okay? If you still own the property and you haven't sold it, this is how you determine how much in profits you have. So the total profits for this property for the last 8 years is $220,000.
Nice. That's awesome. Pretty freaking cool.
Yeah.
So simple. To spit out a number like that.
$220,000 on one basic little property.
I was going to say, like, on a, like, I'm sure there's, like, when you first spat out how much we purchased the property for, there's probably a whole bunch of people going, $250,000? Like, where is this? What kind of piece of shit is that? Like,
just a normal basic house.
Yeah. Just
a normal basic house.
Yeah.
But that's not $1 million. Well, keep in mind that scale, right?
Yeah.
What scale are we at? We're at a $250,000. Is it a $250,000 house or is it a $2.5 million building?
Yeah.
It's just a 10-time difference, right?
Yeah.
And this is the important part. Would you rather own 10 properties at $250,000 each that made $220,000? Just keep in mind, $220,000 times 10.
Yeah. Well,
how much profit is that? Oh, let me rephrase this for you, because I think that people look at it, there's like, oh, the 2.5, I want a $2.5 million building. Because that's going to make more profits, comparing it to a $250,000 house. Okay, let's just multiply the profits by 10. So instead of $220,000, we made $2.2 million in 8 years. Whoa, the response is so much different in the crowd. Holy shit.
Yeah.
It doesn't matter. It's all relative, guys.
Yeah.
You guys got to remember this is relative. $220,000 on a $50,000 investment. I'll give you a different scale. Would you rather make $220,000 on a $50,000 investment Or would you rather make $2.2 million on a $500,000 investment? They're both the same.
Same.
They're both the same. How many people said I want to make $2.2 million on $500,000? They're both the same.
Yeah.
Yeah, but it's more money. Yeah, but you had to bring more money. You had to bring 10 times as much money to bring 10 times the same return. It's the exact same thing. And it blows my mind that people cannot wrap their head around this. It is the exact same thing. So you need to look at what scale you're at. And the people think that bigger means more, but the problem is that most people don't realize that they'll put more money in and make less returns. Right? So you guys got to focus on the most important metric, which is return on investment. And I'm going to share that number with you right now. This is the most important universal metric that you can use for any deal. And that is your returns divided by your investment. Okay? How much money did you put in? How much money did you make relative to how much money you put in? So if you take your total returns and you divide it by your investment, you get your return on investment. The total ROI for this property over 8 years, this is the drum roll, and this is the one that Gabby's been waiting for. What has our ROI been on this property? This super basic, boring property that's got 3 bedrooms, a kitchen, and some baseboards. You can do how many cartwheels in the yard?
20.
20 cartwheels in the yard. My goodness, what a basic bitch. The ROI for this property, this basic bitch, is 440%.
Wow. 440% ROI.
Do you know what that works out to be for the average ROI per year?
Tell me.
55%.
Holy shit. Okay.
On a property that just basically went up 5% per year in value. That had a slump there.
And
pretty average cash flow.
yeah.
It's gone up significantly since because cash flow goes up over time, but pretty average cash flow when we bought it, pretty average property. Nobody was like, oh my God, Wayne and Gabby bought this property. It was not exciting.
Yeah.
Everybody else was like buying, exciting looking properties. But this property, just this basic property that we bought, got an average ROI of 55% per year, just in 8 years. And you know what's going to happen? That's only going to go up. Because now that we're getting over the hump.
Yeah. These are all the thoughts that are going through my head right now. First I'm like, okay, compare 50% annualized return to anything else that you're investing in. Like,
sure.
show me somewhere where you can get that kind of annual return.
Sure.
But then I'm also like, wait, we're only at the 8-year mark. Like, we haven't even gotten into the good stuff. Like, we're just getting into the good stuff. We're just
getting over the hump.
And then this is like, I'm so like internalized right now. I'm just like in my own little, my gears are going, but I'm also like, this is just one little property. And you were comparing it to like a multi-unit, while over here in my own head, I'm like, it's been so long since I've run like, what do you call those? Like wealth statements?
Mm-hmm. Sure.
Personal wealth statement?
Personal net worth.
Personal net worth. Thank you. It's been so long since I've done that. And our portfolio has grown exponentially since I've done that. And
Gabby doesn't know what we're worth.
I have no idea what we're worth.
I haven't told her.
And like all that's going through my head is like, this is just one little property. So like, I can't even fathom like putting it all down, looking at how much mortgage pay down is on each of them, looking at how much, is in the bank account of each of them, like all that stuff. I can't even go there. I don't even. Yeah.
I explained this to actually.
Sorry if I'm a little quiet today.
That's okay.
I'm just like.
I explained this to Gabby yesterday when we were sitting down for dinner, and I said that in the beginning years, our net worth did not look all that exciting. We built lots of properties in our portfolio. The thing is that you don't build your wealth until the long term, right? The first few years of mortgage pay down and appreciation is very fucking boring on your properties. And you don't build a significant amount of net worth in the first 5 years. What ends up happening is that over the years, once you get past that 8-year hump, more and more starts building, right? Your cash flow starts to go up because your expenses are still the same every month, more or less, but your rent continues to keep going up at a faster rate. So you start to see your cash flow start to go up a lot more. And that's why I say, if you want to retire from your job, just join our program, be patient, and wait 15 years, and I can show you how to do it safely. Right? You could be worth millions and have all the cash flow you want to quit your job, okay, if you're patient. But most people aren't patient. They want to quit now. But you're going to notice your cash flow goes up over time. But also what happens is after that 8-year hump, mathematically, you start to see more mortgage pay down. And then you also start to, because real estate values go like this, they don't go like this, you're going to finally get one of those upticks on the value somewhere in that 8-year range. And you're going to have some really, really good years, which is going to balance out that annualized appreciation rate of about 5% or 3 to 5%, right? So you're going to finally, if you have like a couple flat years, your values of your properties don't look that good. Your portfolio value doesn't look all that good. It hasn't gone up nearly as much as some of those other gimmicks or schemes. But you'll realize over time, when you've had a few of those upticks, then you're going to realize some of that appreciation growth. And you're going to finally see the mortgage pay down. You're going to finally see the appreciation. You're going to finally see the total cash flow getting added up. And you're like, oh, wow, this thing actually is profitable. You just haven't given it enough time in order to marinate before it cooks.
Yeah.
And fuck me, this property is cooking. You just got to let it cook.
Yeah.
Like the kids say.
Yeah. I think there's a little part of me right now that also feels like a little bit of sadness. And this probably makes zero sense to you. And I'm sorry for butting in. But the little part of sadness that I feel is thinking back to, the early years when I was like, why are we doing this? Why are we going through this? Why are we dealing with all these tenant issues? Why is this the path you chose? And why are you subjecting me to it? Like, I was just mortified that this was, what you chose for us and that it was what I had to do with my life. Like, I hated you sometimes for it. And I think about now, like, where we are and looking at this, and I think about all of the people who, are here and are following us and are looking to us for guidance. And I think about their partners who maybe are having trouble bringing on board, whether it's your husband, whether it's your wife, whether it's your girlfriend or boyfriend, or, whoever it is in your life. Maybe your parents are worried about you. Maybe your sisters and brothers are worried about what you're doing. And they don't have the vision that I didn't have back in that time. And they're scared and they're worried and they're, wondering why the heck you're doing this. I feel sad for like that old version of me and that version that a lot of you are dealing with right now. And I wish that we could just show them. I wish that we could just pick them up and carry them forward 10 years and plop them down and be like, but look, it was worth it. You know what I mean? But we can't. There's no way to do that. We can share this show with them and show them what's possible and that, I was somebody who was in the same spot. But until you're there yourself, some people just need to experience it, right? And I'm one of those people. Wayne tried so hard to tell me what was going to happen and to tell me to trust him and, to try to assure me that it was all going to be worth it. He couldn't there's nothing he could say or do that would make me believe him until we landed, right? So that's why there's a little bit of sadness roped in here with me. I'm just thinking about, the old me and all these people who might be in similar points that they're experiencing.
A lot of our followers are logical people. And this is why I wanted to do today's episode, was because I knew that this is what they needed to hear. Yeah. The people that are willing to actually listen and to see through the math, like in its most simplest form. And that's why I simplified it as simple as possible. So you guys can actually just see it. You can bring your 10-year-old daughter or son and, show them this episode and they'll be like, oh, okay, yeah, that's cool. That makes sense. Right. And they can understand it. So that's what we try and do, is try and simplify things as much as possible. And people don't like to see simple. They want it to be complicated because they want to feel smarter, but it doesn't need to be any more complicated than that. You just look at the numbers. That's all you got to look at. Just look at them, right? Yeah. So that way you can see what we're talking about. And on the note of personal net worth, there's a couple of different things I wanted to bring up here before we wrap this up. Is on the note of net worth, as I mentioned earlier, in the beginning, it is so fucking slow to start. because it doesn't go fast in the beginning. It starts off very, 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 very slow. And then you hit that 8-year hump and it starts to go up like this. And so being at where we're at, you know, I was explaining to Gabby is that, like, you know, a lot of the early years for us, it was really hard to show her and justify the worth of all the hard work.
Yeah.
Especially in the early years, you are spending so much time building, and it is so difficult to build because nobody trusts you. You don't have you haven't shown proof of concept. Your numbers are mediocre. It is so incredibly difficult.
Yeah.
And so you have to work 10 times as hard in order to get that lawnmower started.
Mm-hmm.
Right? But then once you get it to that point, past the 8-year, 10-year mark, then you start seeing all of the results. People start seeing, you know, what you've been doing consistently. They're like, okay, this isn't just a quick little, you know, side hustle they're doing. This is the real deal. And then so raising capital gets significantly easier. You start seeing more in appreciation. You start seeing more in mortgage pay down. So your net worth kind of goes like this in the beginning. It doesn't matter how many properties you own. It's very low. And then you kind of get to this point and your net worth suddenly just starts to go up. And you're like, oh shit, I didn't know that.
Yeah.
But then 5 years after that, it doubles.
Starts
and
speeding up.
it really just starts speeding up. And this
Yeah.
is what I mean. It's a very, very slow start. It's a low and slow approach. Real estate, you know, long-term buy and hold is not for impatient people.
Yeah.
But if you are patient, what you're going to notice is it goes like this. And then you see all those people who've owned real estate their whole life and you're like, wow, they're so wealthy. I want to be like them. And you try and do it the way that they did it. And you're like, that's fucking boring. Well, you got to have patience. It's low and slow, guys. We're making a brisket, not a burger.
I like that.
You have to be patient.
Yeah.
You got to trust the process. You got to trust the math. And I feel like I'm the only one that's actually showing the math.
Yes.
And so I hope that people are actually listening.
Pay attention.
Because if you listen and you pay attention, you're going to do really, really, really good. You got to be patient, though. All right? It does require patience. This property the cash flow has kind of gone up and down over the years because of just different interest rates.
Mm-hmm.
And obviously property taxes go up and things like that, and insurance and things go up. So it's hard to, that's why we do a pro forma. You know, we do a pro forma to kind of see the sustainability of it. Is this thing actually going to last? Can it weather the different storms? But ultimately, this property right now, this boring property we bought for $250,000 that is worth $380,000 that we have not refinanced or done any creative strategies to. Cash flow is about $700 a month right now. And all that goes into the reserve fund.
Yeah.
So $8,400 a year goes into the reserve fund. And then we spend about $1,000 a year on just random shit. Maybe $2,000 a year if it's a bad year.
Mm-hmm.
Right?
Yeah.
And then there's $6,000 just sits in there.
Mm-hmm.
Sits in there, doesn't do anything. Right? Really super simple. And we got great tenants in there that just renewed.
Yeah.
They love the place. You go and look inside and it's just like, it looks like their home.
Yeah.
And I love that. Compared to other properties that give us the fucking headaches, that hammer the nail in my fucking forehead, the ones that really bother me, and I'm always thinking about, you go in there and there's just fucking cardboard boxes everywhere and half empty, you know,
pop cans
with fucking fruit flies everywhere, and there's garbage outside the door, right? It's just, like, why the and it's hard, like, you know, you're like, why the hell am I doing this? Like, nobody treats this with respect.
Yeah, how do people live like this?
You got this beautiful property over here where there's a family just, you know, they got the swing set in the backyard and there's kids doing 20 cartwheels and running into the fence. You know what I mean? It's just like they love it. Planting flowers and ornaments and things like that. Just making it truly a home and just really taking good care of it and letting us know when things aren't working so we can send someone down there to fix it. That's real estate investing, guys. That's how you do it properly. That's low stress, low management. This is why we're able to manage as many properties as we do on our own. We don't need property management because we buy the right properties that people actually take care of, that are really easy to manage, right? And I hope that you guys are starting to pick up, you know, over the weeks, over the months, over the years of us doing this podcast, free education, free coaching. You buy the right properties and you set up the right systems. It's really super simple. It's low stress, high returns, low risk. Okay. And I hope that this is just another piece that helps you understand it better. And I hope that we can continue to keep helping you guys buy the right properties, that are going to get you solid returns with low risk. Why we're here. If you guys want to learn more about coaching, just go to our website, reimasters.ca. Go book a one-on-one coaching call if you just need a quick 1 hour with me just to look at a deal or help you work through a problem, or join our 12-month mentorship program and we'll help you get all set up within a few months. You could be buying properties, maxing out all the savings you got, and we'll get you learning how to raise capital, get you into creative financing and all those other things, and setting up your systems for the long term. We're here for you. Hope you guys have an awesome day. On tomorrow's show, we got a special guest. Speaking of bookkeeping and taxes, we got Steve Sana with Fingo Bookkeeping and Tax on the show. We're going to be talking about expenses, and we're going to be talking specifically about vehicle expenses.
Ooh, fun. I like that.
We'll see you guys tomorrow.
Bye.
Thanks for listening. Want to be coached personally by Wayne and Gabby? Then you should join the Real Estate Investing Masters Mentorship Program. Details are in the show notes to get started.